Good morning. I'm Carla Jones, Chief Financial and Administrative Officer at the Community Foundation. I'm here with Elizabeth Monticelli. We just finished up another investment committee meeting, and so we thought we would give you an update, as we have been this year, just to keep you apprised of what the committee is discussing, decisions that are being made, and just kind of the environment and what we're seeing in the market conditions. So, as we all know, there was just an election. And we know that that's going to have some impact, but overall, I know you've said over time, it's really not quite as significant as people might think. What are you thinking now that the election is over?
Well, so our analysis is exactly what you said. We've gone back over time and looked at what happened after each election. It's just one day. And the foundation has a much longer time horizon. So it's one day and 1 year. However, when you look at the 2 years after an election, generally the markets have performed positively, about an average of, I think, 8% over all elections since about 1960. And then we look at the results of the election, and do we have a divided Senate versus a House versus the president? And we've done those types of analyses. And generally, again, it's all positive 2 years later after an election, and probably the best result is divided Senate versus House.
Okay, all right, so more to come as we continue to watch. We also know that the Fed is meeting today. And what are we expecting from that?
Great. So we already got 50 bp cut in September. And I think at this point, the inflation numbers are coming in. They're where the Fed wants to be at that CPI and PCE numbers. So now they're moving on to the jobs data. And we're expecting a 25 basis point cut today. And they meet again later this year. And there should be one more. But we got the 50 in September. Markets reacted positively. Strong economy. Good, as I said, inflation's slowing. It's just job growth that they're watching closely today.
Okay. And we know that the U.S. economy has done very well. The markets have been strong. How is our committee, I guess, having the discussion regarding U.S. versus global?
So the last couple meetings, we've spent a lot of time talking about U.S. and the weight of the U.S. companies in the total world market. And their concern is, while the U.S. has done extremely well, we don't want to take too much risk and be too overweighted U.S. So currently the portfolio for year to date pretty much is in line with the all-country world index. And still the U.S. represents a really high percentage of that. But you are neutral on a market capitalization basis of U.S. versus international. And some of the reason for that, and some of the committee, there was a lot of discussion about should we reweight and do more in international, or should we use an equal weighted benchmark? And we had examined and done analysis on those results, and you don't want to be overweight mid-caps, you don't want to be underweight U.S., and we don't see a compelling reason to overweight international. So after the discussion, the portfolio is currently still neutral positioned with the all-country world index, but at the next meeting, we're going to revisit that, just again, because the U.S. concentration is so high.
Right, and so the concentration, tell us a little bit more about that.
So the U.S. market represents, or the U.S. companies, it's the Magnificent Seven. It's been the Magnificent Seven all year, and U.S. has got that innovative tech. We've got the artificial intelligence. We deliver on the profit margins. Revenue's great. And we're just very efficient market.
Why don't we talk just a little bit about some recent decisions the committee has made? So REITs has been a topic of discussion for a while, but there was a decision made by the committee.
Yeah, so we really analyzed real assets late last year and again in March and revisited them. We just had that inflationary period, and real assets didn't perform as expected, so the committee had removed some of them, but left REITs after much discussion because they were significantly undervalued. Everybody knows office REITs since the pandemic have struggled. So we waited, and now over the trailing 1 year, REITs have earned 25%. They're up 16% year to date, had a great Q3, and after again analyzing everything, the committee decided to exit that overweight allocation to REITs. It was about a 3 percentage point, and now we're neutral, and that moved back into global equities. So that was today's decision.
Right, after much debate. So. As always, the committee has an eye on what the fees are for these portfolios. anything you want to add to that from that perspective?
It's always a topic of conversation. Whenever a change is made, we focus on fees. And is there some way we can lower the fees? We don't want them to go up with the managers. So we're constantly looking to see what we can rebalance and reallocate that makes sense for on a risk and return basis. It's not just a fee-driven decision. So that's what we were doing again today.
Right, right. Well, thank you. As always, we appreciate having Mercer in town. It's an opportunity for our investment committee to meet with them, but also we have fund holders who come and meet with them. So if you ever have specific questions about the investment portfolios, please reach out to your relationship manager or to the Community Foundation team, and we'll do our best to answer your questions or connect you with Mercer if necessary. So thank you.